George. Talk to us about maybe we can get right away into where we are at the market. It's a very inflection point of the market, I would say, where we are today. Obviously, we have somewhat of a new administration. No, it's been more than a couple of years that we've had the new administration. Could we call it a post-COVID era? Could we call it a new era in itself? Because since COVID, we've gone through a few real estate cycles already. I believe we're now venturing into the new cycle that we are, because for the first time after a year and a half, the Fed finally has dropped the rates and just created this new cycle. You still have sticky inflation that exists there. You have a Fed chair who's being forced by the President of the United States, the most powerful man in the world, to forcefully bring down rates as if it was something he can control, as if he can arbitrarily change things, as if rates are not controlled by the organic market shifts. But he maybe the market shifts allowed him to see what was happening, and he brought the Fed's funds rate down. But we seem to be on a new cycle. Tell us where we are at today. What are you seeing out there, broadly speaking?
Great question, and I think that's probably the $1 million question, dating back to some old TV shows in the day. But there's a lot of good, strong economic indicators that are out there. I mean, a couple months ago, or not a couple months, but last month, New York, for the very first time, actually had positive office back to office or office actual vacancies opening. So higher for the first time ever since COVID, pre-COVID. It's the very first submarket within the United States that actually has experienced that, but you're seeing that come across. Now, it's interesting in that it's very regional as well, meaning New York, we're actually above pre-COVID levels when it comes to occupancy of office buildings. However, in California, in Los Angeles specifically, where I'm at, I mean, we're still overall across the board at 20+% vacancies, in some submarkets, 40+% vacancies. And even higher availabilities with subleases coming up. So, we see that, but we also see some good indications as well. I mean, today there was just a adjustment to the GDP, raising it to 3.8% from the original expectations of 3% and what originally came out for the last quarter at 3%. So we're seeing some good indicators, but also at the same time, I see a little bit of storm clouds still on the horizon, that whether or not we're out of it or not. And these are not necessarily your normal macroeconomic indicators or things that you look at, but little things that I see that I like to track myself for a little bit more insight. And it's been proven, these metrics or so, if you want to call it that, they tend to be more human-based versus economic. They're economical, but they're human-based in how the U.S. is spending their money. And I like to track that because I think that's a good indication of what the actual consumer feels. And therefore, we can adjust and make plans or look for opportunities at that time as well, where that might be. So, for instance, 2 months ago, there's an announcement that was made that fast food restaurants, for the first time since COVID, has actually seen a drop in breakfast sales. Typically speaking, in recessionary, early recessionary components, breakfast sales in fast food restaurants are the first things to drop off, because it's just as easy to grab a banana or a toast or cereal, and a lot less expensive than going through a drive-through for breakfast. From there, we start looking at the new numbers. There were some interesting articles out the other day about how demand in boxes for e-commerce has dropped by over 20%. So, and this is year over year versus from COVID levels. COVID was at the peak. So we're seeing that, but then also at the same time, what was even more indicative, I think, and this is interesting, is that for the first time since 2008, actual sales in the service industry dropped. So people are pulling back on paying for services, whether it's mowing their lawns, cleaning their pools, whatever it is, and actually doing the work themselves, which is indicative of what the consumer is seeing. So where we are right now, I'm not sure. I mean, I know there's a lot of good indications out there that appear to be good, and I think that there are some really good opportunities out there, like there are in any market. But at the same time, I'm not all bullish. I'm not all in yet.